In the futures markets, like the NASDAQ E-minis, there is a buyer for every seller and there is a seller for every buyer. This is an important concept to understand. Every trade on any futures markets, there's always a buyer and there's always a seller. Now, every trade in the NASDAQ E-mini futures market is a dance of price action between a buyer and a seller. Again, for every buyer, there is a seller, and for every seller, there is inevitably a buyer. Once a trader enters the market, if they enter as a buyer, they will have to become a seller to exit the market. And if they enter as a seller, they will need to become a buyer to exit the market. So there's always a seller for every buyer. This interplay affects the markets, and that's why the markets are always shifting. The market is never static, it is always dynamic. The futures market operates as a venue where these participants meet to negotiate contracts, with each futures contract involving a buyer and a seller. Price action comes into play when a transaction occurs as a result of a buyer and seller agreeing on a price for a particular E-mini futures contract. However, as day traders, we must keep in mind that the term buyer and seller here can encompass more than just individual investors. These terms can also represent financial institutions, hedge funds, commodities traders, and even automated trading systems, all of which are continually analyzing price action to inform their decisions, be it day trading or swing trading or even trading for a much longer term. They could be investing for 20, 30, 40 years or something like that. These entities can act as a buyer in one context and a seller in another context. And since they have a much longer time horizon than you do, their effect on the market is much larger, and we should be aware of them. These entities rely on very sophisticated futures trading strategies, and their impact on the market can be much larger than ours. That means we must be aware of them and trade accordingly. Furthermore, although each NASDAQ E-mini futures contract involves a buyer and a seller, not every potential buyer or seller will necessarily find a counterpart willing to agree on a particular price dictated by the current price action and complete the transaction. Sometimes a seller might want to offload a contract, but there might not be a willing buyer at the price the seller wants, or vice versa. This lack of matching can lead to changes in price action of the NASDAQ E-mini futures contract. While it is accurate to say that every completed futures transaction includes both a buyer and a seller, it does not mean that every intention to buy or sell a futures contract will result in a successful transaction. The interplay of supply and demand in the futures market, influenced by a variety of factors, ultimately determines the price action and the price at which transactions take place, shaping both day and swing trading strategies. There's a common misconception among traders about what causes the markets, such as the NASDAQ E-mini futures contract prices, or indeed the price action, to move. It is essential to understand that there are two types of orders in the market: aggressive orders and passive orders, each of which can be placed by either buyers or sellers. This means you could have aggressive buyers or passive buyers, or you could have aggressive sellers or passive sellers. Now, aggressive buyers will enter the market using a market order. A passive buyer will enter the market using a limit order. And on the other hand, an aggressive seller will enter the market using a market sell order, and a passive seller will enter the market using a limit sell order. These different order types affect the way the price moves in the markets. Aggressive buyers and aggressive sellers are those who are willing to trade at any available price. They just want to get in right now and they don't care what price. These are the buyers or sellers that drive the price action by actively pursuing trades. They show a sense of urgency in their acquiring or offloading futures contracts. This can be particularly pertinent in swing trading, where traders seek to profit from huge price swings over a period of time. These market participants typically place market orders which are executed immediately at the best available price. On the other hand, there are passive buyers and passive sellers. These market participants have a specific price in mind and will let their orders rest on the order book until an aggressive market participant agrees to pay or accept their price. These are typically limit orders, where the buyers or sellers set a specific price at which they are willing to trade. In terms of price action, these passive buyers or sellers, their orders will not immediately affect the market. They will rest on the order book until an aggressive buyer or an aggressive seller decides to move the price, in which case their limit orders are then moved by the aggressive market participants. Imagine the Nasdaq E-mini futures markets. On a busy trading day, Trader A is an aggressive buyer. He's seen some strong positive economic indicators and think that the tech sector, which heavily influences the Nasdaq, will surge today. He doesn't want to miss out on potential profits, so he places a market order to buy contracts immediately, regardless of the price. This urgent buying can drive the price up as he snaps up whatever contracts are available. On the other side, we have Trader B, a passive seller of the same Nasdaq E-mini futures contracts. She believes the fair value of the contract is at 14,000 points, and she's not willing to sell her contracts for anything less. So, she sets a limit order to only sell when the price reaches her target of 14,000. While her order might not make an immediate dent in the contract's price, it adds to the number of contracts available at the 14,000 point mark. This can act as a potential resistance level for the contract's price. As the day progresses, more and more aggressive buyers, like Trader A, enters the market, the price of the Nasdaq E-mini futures might climb. But when it approaches 14,000 point level, it may find resistance due to limit orders like Trader B's. Only after all those passive sell orders are fulfilled might the price have a chance to move beyond that level. Understanding the interplay between these different types of orders and market participants is vital for comprehending the price action in the Nasdaq E-mini futures markets. Both aggressive and passive orders influences the market dynamics, either causing the price movements or creating potential barriers to such movements. It is the equilibrium or the disequilibrium between these orders that often leads to price changes, which are a key moment for both day traders and swing traders to execute their strategies. Nasdaq E-mini futures, the three key elements of price action trading. In the realm of the Nasdaq E-mini futures contracts trading, aggressive market participants centrally play a pivotal role in shaping price movements. However, the strategies that they employ, whether it's swing trading or otherwise, these large institutions dictate the market's overall direction. On the other hand, day traders, even when engaging in swing trading, may not exert as much influence on the market as their larger counterparts. It's important to remember this, that as a day trader, we do not control the price action. We are riding on the waves caused by these larger financial institutions. Their impact varies greatly based on how frequent they're transacting, the volumes at which they're transacting, and the complexities of their strategies that they're implementing at the current time. These all affect the overall direction of the market more so than any day trader will.